All right, what's going on, everybody? Good to see your smiling faces today. Let me know in the chat that you can see and hear me okay. I want to make sure everything is working. All right. Looks like we are firing on all cylinders. Car. That's a good one to start off with. Once everybody hops on, we'll talk about what the how the why the market is responding negatively to the hearing with the new next Fed chair, Kevin Warsh. But let's look at car because that one's a very interesting one. Um, okay. All right. So this is Avis Budget rental car company. Now you can see their stock was not doing that well for quite a while. In 2021, they started doing better. Then they had this massive short squeeze, and then the big crash. Stock has since fallen, and now new short squeeze is taken off even higher than that last one. So the question is, how high can it go and when will it end? And what's causing this? So a couple of things, like you guys are familiar by now with short squeezes like the GameStop AMC story, that kind of thing. When a lot of people think that the stock is going to go down because it's a bad company, they will short the shares. The way that a short works is I don't own the shares, but I want to sell them. I have to borrow the shares from somebody else, then I can sell them. I get the cash in return for selling the shares. In order for me to close out that trade at some point in the future, I need to buy back the shares so that I can hand them back to whoever I borrowed them from. That is the round trip description of what a short sale is. Because shares are fungible, meaning all shares are equal in value and function, you can get extremely high short interests on shares because if I borrow shares from somebody and sell them, I am currently short those shares. The next person, they bought them from me. If they want to, they can lend those shares out to somebody else who also wants to, who is shorting them. Because this process can go multiple times, you can get extremely high short interest on shares, sometimes over 100%. Now, there's nothing um, like fraudulent going on here. It's just shares are fungible. So whoever holds those shares can do what they want with them. They can lend them out, they can sell them. Um, and so sometimes you can get extremely high short interest on shares. That will tend to happen when a company is like a bad company because everybody expects it's going to go down. So they want to profit on that. When that happens, um, it can cost some money to borrow those shares because if there's such a high demand to borrow those shares, well, me, if I'm going to lend them out, I'm not going to lend them out for free. I'm going to charge interest on that. Um, Sometimes companies will see their short interest skyrocket and because everybody's trying to short them. And then you have the setup for a short squeeze, which means if everybody is trying to short, then that's a lot of selling that has taken place. If the stock moves up at all from somebody closing out their shorts, a new player coming in and buying shares, the company has some surprise earnings, something happens to push the shares higher, then everybody who is short suddenly starts to have losses. Maybe their margin limits get hit, maybe their risk limits get hit, maybe something happens. They're just like, I want out of this trade. So they start closing out those shares, those shorts, which means they have to buy shares from the open market at whatever price they can. If I go out and try and locate shares to purchase, and everybody is trying to do the same thing, me and everybody else who's short, we're all trying to buy shares to close out our losses. Well, that's a lot of buying pressure that can skyrocket the stock. So what's going on here? Specifically this, little bit of a unique situation because there is one hedge fund that really likes this company and they own like 50% of the available shares. Another hedge fund came in and saw that and is like, hey, I don't think they're going to sell their shares because they really like owning a big chunk of this company. And so this other hedge fund came in and said, we're just going to start buying up as, we think we have enough where we can buy up like the other 50% of the shares. And again, shares are fungible. So you can have more ownership because you're buying something that's been lent out. So between these two hedge funds, they cornered. This is called cornering the market. They basically own the vast majority of the available shares. Well, suddenly now, everybody who's short, they start to have these losses. They need to go buy shares in order to close out their shorts. There's nobody who's selling. There's because these two hedge funds are like, no, we're not going to sell to you. We're holding these things. And so in order to entice anybody to sell them shares so they can close out their shorts, they have to say, okay, well, I'll pay you $300 a share. And then next people in line are like, oh, I'll pay you $400 a share. It's like, it's just skyrocketing because anybody who's willing to sell is only accepting higher and higher prices. So the question is, when will this end? We don't know because obviously at the end of the day, these companies who are holding these shares are doing it to make a profit. So they need to close out their trade too at some point. The longer they hold, the higher those profits can go. But the wild card here is what if Avis starts to issue new shares and dilute the shares to take advantage of this because they're like, hey, this is a prime opportunity to raise some more cash so that we can, survive longer, maybe reinvigorate our business, maybe hire, do something. I don't know, just take advantage of this because our valuation is so high. Let's dump some shares. And then that could undo this, bring everything down. Then maybe the hedge funds decide to close out. Who knows? That's what's going on here. The reality is we don't know how high this can go. It could go up. It could go up 10x from here. Who knows? Or more. We also don't know, how fast and violently it can come down once the hedge funds who own most of the shares decide that they've had enough. So sometimes it can be fun playing these. If you're going to play it, risk mitigation is the number one most important thing with any trade, which means that you want to make sure that whatever amount you put into a trade like this, if you're going to try and write it up or write it down, if you're going to try and short, if you're going to try and do anything, make sure that your worst case scenario is you only lose a very small percentage of your portfolio. Now, if you're going long, that can be done through position sizing. If you're shorting, that's very dangerous because this thing can gap up, like it could double overnight, even from current levels. And so it could leave you with theoretically, you're in an unlimited loss potential situation if you're actually shorting these shares. That would mean, in my opinion, if you're going to try and do that, maybe you try and buy puts instead of shorting the shares. Or if you want to short, then you also buy calls to hedge. Can be very dangerous to do that on something like this. But if you time it right, who knows? And that's part of what's fueling this is like everybody keeps on jumping in, being like, hey, I think that this is the top, so I'm going to short here. And then it goes up, they get squeezed out, they contribute to more buying there to send it up higher. So fun stuff. Not something that I'm touching. All right. Let's see here. I'm going to look at the questions you guys have been putting in. From Cade Wilcox. What brand of t-shirts do you prefer? They look comfy. What's the rest of your normal live stream fit? The shirts is so funny. I'm like, this is like maybe, I don't know if it's OCD or just a, personality thing. I will go through with anything, technology, knives, clothes, whatever. I will test a bunch of different things. When I find something then that I like and I know what the alternatives are, I'll just go all out and I'll like stack. So my closet, literally, I have dozens of these shirts. They're Next Level brand. The code is 6210. So Next Level 6210. It's a CVC. Depending on the color, it's like a, maybe like a heather blend or whatever. It's like a tri-blend shirt. Extremely comfortable, extremely good fitting. And they're super cheap. They're literally $9 on Amazon. I think I have an affiliate link for these shirts in my YouTube video description, maybe. I'm not sure about that. I may not have that there anymore. They're the best shirts. They're super cheap. They're very durable. They last a long time. They fit well. And the pants, I just found these. Same thing. Once I found these pants, I was like, I'm bidding every single color. They're the VRST from Dick's Sporting Goods. VRST, they're the Limitless Performance Slim Fit. Um, Super comfortable, super breathable, really good form fitting, flexible, all that kind of stuff. Fantastic. But the pants are expensive. They're like $98. So shirts are good though. All right. Let's see here. Next question from Toxic Boyfriend. What do you think of Trump extending the ceasefire? He didn't just extend it. I don't know if you saw, but it's indefinite. So it wasn't like he extended it for like 5 days or whatever. He just like indefinitely the ceasefire is in effect now until he decides to, end the ceasefire. He said it had something to do with everybody in Iran asking him to do it. We'll see. It looks like from the kind of the bottom of the market, it looked like Trump was trying to find a way out because realized this was a mess that he couldn't really get his way out by going through unless he just decided to go all out, basically nuke the entire country, I guess. I don't know. And he didn't want to do that. So trying to pull out in a way that allows him to save face a little bit. I don't know. The market is pricing in that it's over. Market could be wrong, but that's what the market is pricing in now. I think the market's probably right. From Dacha9988, do you think Legendary Biotech is still looking bullish? You're gonna have to put this symbol in there because I don't know the symbol, and also I don't remember that name. So maybe it's something that you had me look up on a prior live stream, and the chart looked bullish to me. It's not ringing a bell, so I don't know. Throw the symbol in for me. All right, question from Larry Moore. Still chasing money. What a shallow and unworthy pursuit. Here's kind of a counterpoint to that. As long as there's no coercion involved, when you have a profit, that is a direct result of the other person on the other side of the exchange getting something that they want more than what they have to give up. So when I buy a burger from somebody, from let's say In-N-Out, I want that burger more than I want that $5. So I am better off as a result of that exchange. In-N-Out wants the $5 more than they want that burger. They're better off because of that exchange. It's not that either the burger or the money is equal in value or that one or the other is more valuable inherently. It's that to me, that burger is more valuable than that $5. If the burger was more valuable inherently, I would try and spend all my money on those burgers. But it's not. It's just that burger is more valuable. Or maybe I want two. So 2 burgers is worth more than that $10 to me. But past that, I'd rather have the next $5. That is how all exchange works outside of coerced exchanges, which means anytime there is voluntary exchange, both parties are better off. That is the definition of profiting. I give up something I want less and I get something in return that I want more. That is the reason why people go to work typically for 40 hours a week, because they would rather give up that time and that skill and that labor to somebody else for that amount of money they're receiving. And few people decide to work overtime because they value that next 5 hours a lot more than the money that they would get in return for it, even if they do have the choice. So that is how value works. That is how profit works, which means to the extent that you've been able to accumulate wealth, you are making the rest of the world a better place. To the extent that you have been able to engage in free market exchange with people to the point where they have given you excess profits, in your opinion, that means you have given them something that they value more than what they had to give up to get what you gave them. The amount of wealth you build outside of coercion, as long as you're not engaged with government and business at all, outside of coercion, the amount of wealth you build over your life is a direct measurement of how much better off you have made the rest of the world. So if you do not build wealth over your life, if you consume everything you produce, On net, you have not made the world a better place because you have not given other people on net more than what they have given you in their own value measurements. The more wealth you build, the better off you are actually making the world in real terms. So there is no, as outside of coercion, there, in my opinion, is nothing more shallow and unworthy than pursuing a life of no wealth. It is noble and honorable and very difficult to actually build wealth. And it actually makes the world a better place. All right. From Carl Roth. If you're buying individual stocks, that's fine. Doesn't matter. Oh, that's not a question. Okay. Question. Looking for a question mark. Man, lots of okay. All right, so I'll wait for a couple more questions to come in. Let's talk about the Fed now, since there's a couple hundred of you guys on. Um, okay, right here. All right, so we have Kevin Warsh was grilled by the Senate Banking Committee today and was talking about his plans, and the market was not responding very positively to this. There are a couple of reasons why, but basically, the market. The market does not like uncertainty. Um, because uncertainty means risk that we don't know how to account for in one direction or the other. Kevin Warsh is coming in saying that he's basically doing where's the word here? He said regime change. He needs regime change at the Federal Reserve to the point where he thinks that there will be a lot of dissent and disagreement within the Fed, and a lot of people think that. He said he welcomes a good family fight. So going into Kevin Warsh coming in, we're expecting to see some fairly large changes. It's really interesting though, because he really wants to get interest rates down, but he also has talked about extensively how he thinks QE and the way the Fed has done things have made Wall Street richer, have made asset owners richer at the expense of most of the population. And so he wants to change the way the Federal Reserve does things. He's not a fan of the status quo just because that's the way that they would do things or have done things. He wants to abandon forward guidance. He doesn't want to signal to the markets where they're going to have interest rates go. He's not going to look at core personal consumption expenditure, PCE, as the main way to measure inflation. So he's talking about changing a lot of things that have for a long time been central to the way that the Federal Reserve operates and central to the way that the Federal Reserve has tried to deal with the economy. So he's talking about letting banks that take on too much risk fail. He's talking about reducing the size of their balance sheet. So the reason why I say this is all interesting is because he also is like pretty set on getting interest rates, especially long-term rates, lowered. There's only one way to do all these things, and it's possible, but there's only one way to do all these things together, and that is bank deregulation. Because the government needs to borrow an amount of debt that the private economy right now under current rules cannot supply. They cannot afford that amount of lending, cannot afford that amount of debt purchasing. Interest rates will go higher underneath the current regime, especially if you take away the main buyer, the Fed. If the Fed not only is not buying anymore, but they're reducing their balance sheet, doing QT again, you need somebody to come in to pick up the slack. The only way to do that is to deregulate the banks so that the banks can do that lending themselves. I think the idea here is let's deregulate the banks. We'll reduce the size of the balance sheet so the Fed is not doing as much of this top-down, centralized, trying to economic control, fine tuning by our monetary policy. We'll deregulate the banks. We'll push down the Fed funds rate and allow banks to participate in way more lending, both to the government and to the private sector. That will finance production. Because we're deregulating, they have to make sure that they are lending in a way that will produce profits. They're not just going to be lending willy-nilly, knowing that there's somebody who's going to backstop their failure. So they're able to lend a ton more because the rules are super relaxed. But if they fail, they fail. If they take on too much risk, they're gonna lose their shirts. And so, um, it's definitely a gamble. There's definitely some uncertainty there. I think that is the plan that we will see unfold going forward because there's if you want to get interest rates down and you want to get the Fed out of the markets and reduce the size of the balance sheet, the only way to do that is to deregulate the banks. There's no other there's otherwise you just you have a deflationary death spiral. You suck out all the liquidity from the system, and there's a liquidity crisis, and all the banks fail. And obviously, he's not going to want to do that. The other thing to keep in mind is he was instrumental in the bailouts in the financial crisis. So lots of times these central bankers talk a big game, talk about freedom, talk about deregulation, talk about not bailing out the system. They talk about sound money, and they talk about the dangers and the evils of central planning and the government or the Fed being too involved in making asset owners rich. But then when they're the ones in power, they're instrumental in doing the exact same thing. And so when he was at the Fed during the financial crisis, he was instrumental in TARP. Even like somebody like Greenspan. Alan Greenspan talked about the gold standard and talked about sound money and talked about the importance of that. And he got in there. He just slammed interest rates to the floor. And he, probably caused the financial crisis, or at least planted the seeds for it. So anyway, they talk a big game until they're actually the ones, the heavy is the head that wears the crown. The old story. There's the sword that hangs above the throne, and that position of power can make people do things that are very different than what they said they would do before. All right. I saw a question. Somebody said, "What music do you like?" I like a lot of music, just pop music, country music. I don't have any crazy artsy music preferences. Just kind of whatever's popular at the time. All right, let's see here. Question from Fritter6546. What do you think about SATS as a SpaceX proxy? Supposedly they have 2.8% of SpaceX. I think when these companies like SpaceX and OpenAI and Anthropic start to IPO, they're going to suck in a lot of capital, and there's going to be a big pump and then a big dump. There are some ways to mitigate that, but the way that it seems like they're being structured, that might be somewhat inevitable. And so I would exercise extreme caution with this. I don't know if SATS has any SpaceX exposure. At this point, it's probably a little bit on the late side to try and get like pre-IPO exposure to SpaceX if you don't already have it. That'd be like it's all, in my opinion, it's like almost like a short squeeze play. It's like, yeah, you can do it, but you also risk getting burned. All right. Question from Nick Smarty 6835. What gum do you use? He says some sort of nicotine gum, just Nicorette. I've tried a couple of the other brands and they taste terrible. I like the really minty ones from Nicorette, the spearmint and the white. What is it called? White ice mint. I tried the Costco one, the Kirkland brand, and I think I got the unflavored version. It was terrible. I've tried Lucy. They don't cover up the nicotine flavor very well. I like the gum more than the pouches because it allows you to control it. Like it doesn't release unless you're chewing. So you have a little bit of a release and then you stop chewing and you tuck it and it just, stops releasing. And so you get a much more slow controlled release over a long period of time. So like I just do the 2 milligrams just for focus and works really, really well. I don't like the pouches. They hit too fast, too hard. They make me sick. All right, question from Rob's AB055. Do you ever do analysis of stock fundamentals for long-term investments? Yes. Very soon here, I'm going to be releasing free access to my courses. The way that my business used to run, in the beginning when I started on YouTube, my only goal was to grow the channel. So I didn't do any affiliates. I didn't do any sponsorships. I didn't do anything to monetize. I was just like, hey, I need to get, subscribers. I need to get views. So I made a video every single day. That was my only focus. After about a year and a half of that, I was like, all right, I need to start making some money here. So I started doing affiliate links and sponsorships. So I started doing like sponsored videos, like, like most YouTube videos, like, hey, like sponsor today's video is this company. Like, and that the money from that was good. I never liked doing that though. And so I always was trying to get away from that. So I started making courses on portfolio allocation. I've got some that include a bunch of fundamental analysis, technical analysis, options trading, precious metals, all sorts of stuff. And I was selling those. The problem is, education is very, very valuable until you have it. Then it's worthless because you already know it. And so it was difficult to create a business that was, had any sort of a flywheel there. I just had to keep on selling courses. And um, now I don't sell them anymore. I just include them as free bonus packages on my trade alert services. So my business, the way I make money from a business perspective, is just selling access to the trades that I'm making. So I'm investing, I'm trading, and I share those with my paid subscribers. Um, and so because of that, because I'm not making any money from the courses anymore, I'm right now in the process of releasing them, like, so that you can access them for free without paying for anything at all. The reason why I bring that up is because the question was, do you do any fundamental analysis? The answer is yes, especially for long-term investing. And I have my methods and easiest ways to do that. There's some really, really good tools and easy ways to do that where you don't have to be a CFA or anything. And I'll have that. I'll have that coming out soon. I'll start talking about it in my videos soon. Okay. From Stumpy, I've only just started on a cash and stock ISA. I'm planning on a 50-50 split between the two. Would you alter this? My preferred portfolio allocation is about 30% stocks, 30% real estate, 20% gold, 5% cash, 5% Bitcoin, and then 10% for speculative trading. I'm not so that means that I wouldn't be a huge fan of 50-50 stock and cash. I mean, even if you look at somebody like Warren Buffett, who's like, an extremely conservative investor, they've got like Berkshire Hathaway is like 32 or 33% in cash right now. And reserves wise, when you break down my portfolio, it's about a third in reserves. Now it's not all T-bills like Berkshire Hathaway is, but the cash and the gold and the Bitcoin, plus some hedging from the speculative portion. That's my opinion. That's my preferred way of doing things. Question from Heisenberg, 2VJ18. Do you have any numismatic coin collections, gold or silver? For the most part, no. I do have a couple little things that I just think are cool, but from a financial perspective, the answer is absolutely no. The reason why is because you will almost never make money on them. Unless you are a professional collector, it's very difficult to know what these things should actually be priced at, what they're actually worth, and how you know whether you're getting a good deal on them or not. The amount of metal in them, you're paying 50 to 200% premiums for the melt value of the metal. The idea that if there is ever some sort of a repeat of FDR's, Executive Order 6102, where they come, they're going to, come take your gold, but if you have a numismatic coin, they'll let you keep it. Completely preposterous. There's absolutely no standing for that. It is literally just a scam, propaganda perpetuated by numismatic gold sellers, gold dealers, because they make 50 to 200% commissions on the metal by selling them. So financially, it is not a good thing. I do have like a couple of little things just because I think that they are cool. Like for instance, it's like, oh, if I can get a half an ounce gold coin, or it was, I think maybe it was a quarter ounce gold coin. It was like, a Roman, an old Roman gold coin that was used, around the time of Jesus. It's like, that is super cool. Um, am I doing that because I think I'm going to actually preserve or make any money from that? I'm never planning on selling it. It's like there are some things that I think they're like cool to have, but not from a financial perspective. It's not worth it. All right. Let's see here. Question from Mercurial Duck. If the market is pricing in that the war is over, then what's up with crude oil futures? Well, it's because the strait is closed again. Um, the ceasefire is indefinitely extended at this point. And so war in terms of like actual like fighting right now seems to be being priced in as being over. But the strait being closed is why crude oil futures are up. Okay. Question from All Blue Trading. What do you think about copper? Long term, I like copper. Short term, I still think there's, I'm not in a copper position right now because inventories are just piling up. I wonder if I can find a chart for you. Um, Seems like there's an oversupply right now. Hmm, okay. So this is copper inventories. We're not really in a position where I think short term, I'm not super bullish on copper in the short term. Question from Alex Kimmerly. Will Powell stay on his FOMC chair? I don't think so. I think um, base case is that Warsh is confirmed. And I don't think Powell will stay on the Fed at all. I think doesn't he have that option? Um, uh, yes, he can remain on the board of governors until his term as a member expires in 2028. But traditionally, if he follows tradition, he would just resign. I think he probably will. All right. Question from Night Arrowrent. Hey, Joe, I definitely agree with you on having to unleash the banks, but the question is, do you think the banks will buy in today's climate with oil on the rise? So you didn't directly ask about this, but I want to make a note. A lot of times when I'm talking about this kind of stuff, I'm being I'm being descriptive, not prescriptive. And what that means is I'm not telling you what I think should happen, like in an ideal world, what the best move is. I'm telling you what I think will happen because that's the only thing that really matters if we're talking about, investing or how we're planning our lives and our future. We can complain all day about the way things are and the way the way they should be. It's not really useful for anything in life to talk about that. So a lot of times when I'm talking about the Fed, especially, I get people saying things like, "Hey, like, why do you think the banks should do this?" Ultimately, they're still printing money into existence. And it's like, yeah, I'm not saying that this is like the best move. I'm saying that I think this is what they are going to do because of the goals they want to see accomplished and the restrictions that they're placing on themselves with, whatever. So in terms of do I think the banks will actually go through this? That's the wild card, and that's one of the reasons why um, the Fed kind of has not been approaching things that way because when the Fed does QE, they just do it. They don't have a profit requirement whatsoever. They print the money they need. When you look at the banks, they do. Now, it's still not like a completely free market business because because they have the ability to print money into existence, lend money into existence. They have many things that prevent or make failure harder. from excess risk taking. There are implicit bailouts in the system, like the BTFP. There are things that make that difficult, but they still have a profit incentive, which means they look at something like, lending to individuals more, even if regulation wise it's easier. They may look at that and say, no, we actually don't want to do that, which means that it's possible they take up all of their extra, risk limits. They increase their, the financialization of the banking system, instead of doing, productive lending to businesses and individuals. They just purchase more risk assets. Definitely possible. So this is not something that's guaranteed to work. It could definitely have negative consequences that the deregulators or the regulators are not expecting. Um, okay, from Mr. Tyrochelo. With your expectations of likely eventual banking deregulation and lower interest rates, what do you what do you expect to happen long term to treasury rates and its impact on the hmm, I'm assuming by open. When you say asymmetric, there, I'm assuming you're talking about the open asymmetric trade inside of our program that you're one of my subscribers there. We have a trade open on TLT. That would, if this is successful, that would make the price of bonds go up because a lot more buying comes in to buy up these bonds as that pushes interest rates down. So the like funds like TLT in the short term will outperform and do extremely well. All right, question from stimulated students. What should an 18-year-old invest in? Well, there's no one size fits all answer for 18-year-olds in general. Um, if my kid was 18 right now, which he's not, thankfully we still got some time. Um, if either of my kids were 18 right now, what I would be telling them is to invest in their ability to produce more income. There is Doesn't matter what studies you look at, doesn't matter what statistics you look at, doesn't matter what logic you use. There is nothing more powerful for wealth building, or your ability to make an impact on society as your ability to produce a high income. If your skill set means that your maximum income is $50,000 a year, it will be near impossible for you to ever get to the point where you are financially free, where you've ever accumulated or built any real wealth, because there's a floor underneath your expenses. You have to live. Like well, you definitely can't go below zero, but if you just want to survive, you have to pay for living, transportation, bills, food. Um, and so let's say you can increase your income to $80,000 a year. The most you could probably realistically save per year and invest is like maybe 20 or 30,000. And that's like if you're living on beans and rice. And you have zero luxuries, probably zero kids, like no expenses. But if you're able to make $200,000 or $300,000 a year, you could save, 20% of your income, and you're investing 60 grand a year, and you won't even notice it. You won't even feel it. Let alone if you're super disciplined and you're able to put away 50% or 60% of your income. And there's no limit to how high your income can go. And so I think that as you're young, the most important things to invest in are just going to be your skills at producing income. Um, Now, I think that the discipline of putting some money each month into a Roth IRA and putting that into some index funds is important for sure. But it's like it's the habit that's important there. Like if you have 25, 50, $100 a month going into a Roth IRA that's in some index funds, it's that habit that is going to benefit you down the road, not the actual money. You're taking your excess money and you are plowing that into learning skills, going to places where you can work for people that, jobs are for learning, not for earning. You're stacking skills that eventually you're able to pile together to be able to be super, super valuable to to people or to a company. Um, when I first started my career, I had always wanted to start my own business. I never really liked having a job and working for people. And I tried a bunch of different little things on the side. Like I tried an email marketing business. I tried starting a bunch of these little things, but I never had the skills to do anything. And I didn't realize that was the problem. I just thought it was, I don't have a good idea. It's like, no, I didn't have any skills. And after I was a broker for years, I had finally developed some skills from being in a professional workplace and learning some high value skills of, investing and sales and communication and a couple other things that I was like, oh, I think that I could go off on my own and use these skills that I've learned and actually start a business and make at least the same amount of money for myself. And even at that point, I didn't realize I was super deficient in other skills that were necessary. That those skills were valuable only because I was pairing them with everything else that the company had to offer. My skills by themselves were actually worthless. It took me 6 months to make a single dollar. It took me a year and a half to be able to make enough just to pay the bills. And so thankfully, I had been very disciplined before that, mostly thanks to my wife. So we had investments and savings. And so we were able to survive a year and a half without making enough money to pay the bills along that whole way. But during that time, I was learning other skills that were necessary to stack on top of my current skills. And then suddenly I was able, once I got to that point, then I was able to start making a lot more money very quickly. And so I think the number one most important thing for young people is get jobs for learning, not for earning, stack skills, focus entirely on earning more income, and being able to be a very, very high income producer, because that's the number one driver of wealth. Okay. Let's see here. From Crittenby, are live streams a new thing? Yeah, the last month or two, I think I started doing live streams like a month or two ago. So fairly new thing. Just to give you guys some insights into why, if any of you guys have content businesses, or businesses where your lead flow comes mainly from producing content. Couple of reasons why I'm doing live streams. Number one, it's easy for me. Like it requires no preparation, no research, no other than the time I spend doing the actual live stream. It's not time or work intensive. I have developed the skills of being able to just know the answers to the questions that I know you guys are going to be asking me already. So it doesn't require much extra on my plate. Number one. Number two, it provides a couple hours at least per week of content that can be clipped out into shorts, which before this, I was not doing any short form media whatsoever. Wasn't posting shorts on YouTube, wasn't posting TikToks or reels on Instagram or anything. So it gives me content to be able to clip out for additional marketing. The third reason, which I think is actually underrated, is that you guys get to interact with me in a way that is a lot more real. Like I don't have research that I prepared, a bullet point outline that I'm saying I need to talk about these things. And I'm thinking about the way that my words are being said. I'm not repeating sentences and saying, okay, cut out that first one because I made a little mistake on that word. It's raw, like, so in a very real way, it allows you guys to get to know me. And as we talk about things like trading and looking at, looking at options pricing and looking at the charts, it allows you guys some insight into what I actually do to make money. Like if I wasn't doing this, I could retire today. If I wanted to, I could stop working. I could stop making YouTube videos. I could stop selling anything. And what I would be doing with my time is just investing and trading. So that's why I continue to do this, is because I'm like, well, this is valuable. Over the last 5 years, I've been able to average a compound annual growth rate of 39%, which is well over the market averages. I'm just sharing that information, what I'm doing with people, and letting them follow along. And so everything that I'm doing is funneled into that, but it's because I'm selling access to something that I'd already be doing anyway. And one thing that I noticed was a lot of people knew me on YouTube about talking about things about like explaining economic topics, but they didn't know, hey, I'm like a full-time investor and trader. Like I know a lot of you don't have the ability to sit in front of a computer screen and research stocks and look up, try and find different opportunities to invest and trade all day. Most people who have watched my YouTube videos have no idea that that's what I spend the majority of my time doing. And that's how I've built all of my wealth. Um, and so these live streams offer an opportunity to give some insight into how I make money, show you, demonstrate in real time when we look up stocks together, and lets you guys get to know me a little bit as well. And I do try and answer every question that you guys throw in there. That way, again, you guys can feel like, okay, like I know who this guy really is. Okay. Question from Chase Sellers. Is your 20% in gold, paper, or physical? It's split up between a bunch of different ways. So there's pros and cons to every way to own gold. There's no such thing as no risk. It's just what kind of risk are you willing to accept, what trade-offs. And so if you have, GLD, it's like the pros to that are, hey, super cost efficient, like incredibly cost efficient. The cons are world falls apart. That's worthless. Like, nukes hit everywhere, the grid goes down, whatever, like post-apocalypse world. It's like, well, that was worthless. If you have physical gold at home, like in a safe, pros are, hey, you always have that no matter what. Cons are, depending on your situation, that might be very dangerous for you. That's the situation I'm in. I have zero gold physically present in my home. I feel like it's too easy to find out where people live today. Somebody's like, oh, Joe's got, $2 million in gold. That's worth risking my life for. The answer is no. I don't keep anything on any physical property that I own that is valuable like that. I have no gold. I have a lot of lead. And so I spread it out. I do a bunch of things. I have a lot of gold with monetary metals as well. So a lot of it is being leased out. And again, the trade-off there is, there is potential risk of a lease or a bond default, but it's never happened before. And I grow my ounces instead of paying for storage. So again, that's not all of it. That's some of it, but I have it spread out. There's pros and cons and trade-offs to everything. So I like to have it spread out a bit. All right. From Rodney Rogers. Have you ever seen a ghost or a UFO? No, I have not. From Brian Dar. No, deregulation is what has caused every crash we ever had. Does history repeat itself? That's not true. The Glass-Steagall Act being repealed actually had almost nothing to do with the financial crisis. There's a good book, I can't remember the name of it, by Tom Woods. Tom Woods books. Let's see. No, not that. Not that. Was it Rollback? No. Can't remember. The reason why people think deregulation does that is because the damage is built up during the time when there's a lot of control by the government, and if they maintain that control, you have slow, inevitable decline. So you have to allow the free market to get back in there to grow things. But because of the rot that's built up in the system, now you expose that rot and allow it to fail. So, all right, let's see here. Trying to filter through your guys' conversations to find questions. Okay, from Dick Whiskey. What are your current thoughts on agriculture inputs? Not sure if this is exactly what you're asking, but I am broadly bullish on agriculture right now. A very easy way to have exposure is DBA. That is the, let's see here. Let me pull up the chart. Yeah, the Invesco Agriculture Fund. Um, it's a really easy way to get exposure to agriculture. Let's take a look at their holdings. Oh, okay. Well, yeah, that's not going to be give us any insight. So this is long term for this fund. You can see it bottomed back in 2020, and it's just been in a really nice, slow little bull market since then. Been encountering this resistance here with rising lows. We've got a nice little wedge forming here. A breakout to the upside there. We could see this bull market continue for quite some time. So that's a nice and easy way to get exposure to agriculture. All right, let's see here. Question from Volga Vanna White. Sorry if you already covered car, Avis. Would the May 15th 300 puts be a good asymmetric trade, or is the post earnings drop already priced in? Well, I don't like to play short squeezes once they already start because it's very difficult to know how high they'll go. It's very difficult to know how low they'll go once the unwind starts. I like to play potential short squeezes before they start and have a predetermined exit point. But once they're going, it's super difficult to time them correctly. And so that doesn't mean you can't make money on them. It means I'm not going to be playing the CAR Avis trade at all. Because even terrible news for the company, you get a bunch of shorts pile in on that, they all get squeezed out because the people who own the shares just decide we're not going to sell still. So, okay. From Boya6585. Not a sin to have a valuable skill, help people and earn money at the same time. Thank you, Joe. I've learned so much from you for a long time. Finally purchased one of your subscriptions worth every cent. Well, thank you. Appreciate the public review there. All right. From WC Jones. How would you convince a skeptic that technical analysis isn't BS? Well, the first question I have is, do you think that human nature is different today than it was a year ago? Do you think human nature is different today versus 10 years ago, 50 years ago, 100 years ago, 1,000 years ago? Or do you think in general, human nature is pretty much consistent across most of history and cultures and languages? Obviously, there are cultural differences, but human nature in terms of greed, self-preservation, the desire to make something of our lives, just some basic things that are kind of common to humans, those things stay consistent. Human nature shows up in human behavior. When everybody all together, you get human behavior that takes place, that shows up in patterns. So what is a stock chart? It is simply the visualization of human behavior in a specific area, in this case, buying and selling in markets. So all you're doing is looking at the history of price, which is the consensus about what the value of that thing is throughout history. And that is driven by human behavior, mass human behavior, group behavior, which is driven by human nature. So because those things don't change over time, you see these patterns tend to emerge. What you also see is a lot of not all of it, but a lot of the information about the company or the market shows up in the price. It's like the fundamentals are published, the earnings are out, the news is happening. And so all of that information is digested by all potential and actual buyers and sellers, coming up with a consensus price in that moment. And that shows up in the price. And so a chart is just the visualization of human behavior trying to figure out what the correct price is given all of the available information. You can also see like institutional moves For instance, the move from the bottom of the market a couple of weeks ago to today was very clearly institutions short covering and trying to flip long, moving so much money that they can't just slam a market order like you and I can and flip from, if they're all short to all long, they'll soak up all the liquidity. And so they're using algorithmic trading like VWAP and TWAP to try and as fast as possible get into the proper position without moving the market too much and getting screwed on price. Very, very like orderly straight climb. It just, is pretty apparent that that's what was going on. And so even if you don't want to do any like major charting, looking at patterns or, anything like that, you can still get some useful information by just looking at the price. You can see general, it's just a visualization of what market participants broadly are doing. Okay. From Unknown YTX, how capital intensive is your trading program? I recommend not doing it unless you have 20 grand at least to trade with. That way it gives you the ability to participate in most or all of the trades. And that shouldn't be a large percentage of your overall portfolio. I like 10% of my portfolio in speculative trades. But for each individual trade, I mean, you can just buy as many contracts as mostly they're options, so you can just limit your trading size to fit your trading account. All right. Let's see here. From Streets Dogs of Baja, I made 100 times more money with Joe than I've paid him for his services. Oh, well, thank you. I should screenshot that. That's a good review there. All right, from Andrew Kraus. What are your thoughts on investing in collectibles? I have six-figure investments in sealed Pokemon boxes, and the investments are not producing the results. Okay, there's nothing wrong with it, but you have to be really good at it. There's a lot of people who dabble in trying to become a collector, and they just end up, getting caught up in the hype of whatever is the current trendy thing, buying a bunch of stuff that is basically at the top of the market, and then they get screwed because they're not really knowledgeable in that particular area. And so they end up paying more for something than it's worth and losing their shirts on it. So there's nothing wrong with it. But you have to treat it like a business, and you want to go really deep into one area and become the expert in that one area. So like, for instance, like Pokemon cards, but you don't want to be also doing, I don't know, are there other game cards that are collected like Digimon? I don't know if Digimon is still it used to be. I don't know if people are collecting Digimon cards, but the point is you want to go really, really deep into one specific area to become the expert. So you actually know, hey, this is a good deal. I'm buying this for less than it's worth. Because that's where the money is made. It's made on the buy. You know what it's worth. The profit is made when you're able to buy it for less than it's actually worth. Rather than speculating and gambling that it'll just at some point in the future be worth more. Thoughts on NOC? Whoa, what's going on? Down 7% today. Let's look at ITA. Oh, down 4% almost. What about Boeing? No. What is Boeing? I always forget Boeing's symbol. The A. Yeah, it probably is mostly due to the indefinite ceasefire. Wait, that didn't happen until after the market closed. I don't know specifically. I really dislike investing in defense companies. Number one, because you get stuff like this. It's just so dependent on, I mean, it's basically an extension of the government. It's like a private, a publicly traded arm of the U.S. government, for the most part. So I don't really like investing in defense companies. So when the government decides to, spend a bunch of money on war and then end the war really quick and, flip flops back, it's like, I'd rather be able to invest in an area that's a little bit more predictable, a little bit more where we can see like, hey, what's this company actually worth? Like, are we just depending on, who's rubbing shoulders in the back rooms and getting their private deals and contracts assigned? So, but I don't know specifically why it's down so much today. All right, question from Brandon. Can you recommend some good books or resources that align with your style of investing? Yes, I finally have this available. If you go to my website, heresy.financial, and you click books at the top. Look at this. I've got a book list now. So I've got my section on economics. These are my favorite economics books, and the ones that are at the beginning here are more favorite. I've got my books on investing that are my favorite books on investing, politics, managing your wealth, history. If you guys want to be wrecked, like if you don't know how evil you can be, read Ordinary Men, and you'll realize very quickly how easy it would be for you to do terrible things. If you believe that, yeah, I highly recommend that. But it's a tough read. It'll wreck you. So lots of good history books there that I really like. Some personal development, some business biographies. So I've got my book list there, and fair warning, if you look at the book and then you click find it on Amazon, that is an affiliate link. And so I'll get like 6 cents if you if you purchase a book from Amazon after clicking on that link there. But those are my favorite books. Okay, let's see here. From Paul Pease. I'm praying for you. Well, thank you. I appreciate that. It doesn't have to be this way. God has so much more for you. Please don't go here. We know the truth. It's not about money. It's to help others. Please don't. I agree. It's about helping others. And the way that that is measured, as long as you're not using force and coercion, is your wealth creation, because that is a direct measurement of how much you have given to the world and have not taken back. If you are consuming everything you're producing, you are not helping people. That is a fact. That's how economics works. You are a net, not a net drain, but you are a net zero on society. So I agree. It's about helping others. And I have an objective way to measure that. All right. Let's see here. Question from Bitcoin Hopper. As far as I'm concerned, you are retired. In my opinion, the day you are no longer forced to have a job, work ceases to have negative connotations. Life is more enjoyable, less stress. Yeah, in fact, from the traditional standpoint, I don't believe in retirement. 2 stories about retirement from both of my grandfathers. So one of my grandfathers, he worked until the day that he could no longer remember how to get home from work, when the dementia had set in. And he lived for a couple more years past that point. But he basically, I in my opinion, I don't know his exact financials, but in my opinion, he could have potentially quit working a little bit earlier and enjoyed a little bit more the fruits of his labor and spent some more time with his kids and his grandkids. I think that was possible. I know how much how much was left. And so I'm not saying that was like dishonorable at all. I think that was very honorable that, he worked and supported his family and left enough for his wife. And there'll probably be some. So I think that's good, but I think that he probably pushed it a little bit too far. My other grandfather, retired when he was like 52 or 53 with a pension and never worked another day in his life. Started collecting Social Security later. And I saw him morph and devolve into less and less of who he used to be. I think men in particular, but maybe just this is a human thing. We need a responsibility and a burden and a purpose. And if we decide to become lazy and say, I'm just going to focus on a life of comfort, we cease to be as human as we can be. We need responsibility. We need purpose. We need something that is like, this is important, that is difficult, and I'm actually working on, but it's also meaningful. Um, I think like I've experienced jobs that are not meaningful, life sucking, where you feel, you maybe you think you're depressed, maybe you just have a really bad job and it's completely meaningless. And Friday evenings are the most euphoric time of your life because you get a break from the monotony and the meaninglessness. And Sunday afternoons are the most depressing because now know you have 5 more days and you can't even enjoy your Sunday anymore because you've got to wake up for work tomorrow. I know what that feels like, and that is not meaningful. And so I think retirement is get to the point where you are financially free enough to quit your job that you hate and focus on working on something that still produces an income. Maybe it's just you don't need as much because you've got a decent nest egg, but you get to focus on doing work that is actually meaningful. Um, that's my opinion. Okay. From Chase Sellers, are you bullish because of the potential urea shortage and the effect that has on fertilizer? That's definitely part of it. We've got a trade on that thesis open right now in the program. That is definitely part of it, but not the whole thing. Let's see here. GNJR question. Dario with Anthropic said we'd have AI employees in a year ago. Isn't it clear this is just Elon Musk type vaporware? I mean, I don't know. I don't know where you like. I mean, a lot of people don't yet, but it's here. I have AI employees. They're called agents. I have, it's and a lot of people do. So it's not super widespread because there's not a lot of people using it and taking advantage of it. There's still a big learning curve, but it's rapidly the adoption is happening rapidly. Um, there are many things that I now have various AI tools do for me that before a year or 2 years ago would have cost, money to pay a person to do for side projects or pay software subscriptions to do. And so there's I don't I it's not just a chat bot where you're asking questions about things and making it generate pictures. It's like there's a lot of people like myself who are using it to accomplish real tasks, real world tasks, produce real things that help us make more money more efficiently. All right. Human nature is human nature. Read Federalist Papers. That's from Boya 6585. Yes. Another thing about this is one of the reasons why I'm a big advocate of reading, especially biographies and especially biographies of like super successful people. And so if you go to my website and you look at the look at the biographies books section, where are the biographies right here. And so we've got biography on John D. Rockefeller, Jordan Belfort, Warren Buffett, Jim Simons, King of Con. Who was that one about? I can't remember his name. That was a very good one. Jeff Bezos, Elon Musk, Ray Dalio. And obviously on my website, I list my favorite biographies, but there are a lot others. A couple of things is like, number one, you realize there's no special sauce. For the most part, a lot of these people who go on and accomplish really, really cool things and build really big things, they're made of the same ingredients. They have the same fears. They have the same quirks. They're people, which means it's like, oh, like they don't have anything I don't have, which means if they can do it, I can do it too. And a lot of times you realize, oh, not only are they not made up of anything different, they have like major flaws that they still had to overcome in order to accomplish the things they accomplished. And so it's very encouraging to see like the stories of broken people who are still able to overcome those things and accomplish. It's very, very encouraging. So I'm a big fan of reading. But it's also easy, just as a warning, to like confuse in your mind learning with doing. Like you get the same dopamine hits like when you learn about stuff, when you read business books and investing books and biographies, is like it feels like progress, but really you're just filling up your brain. You're not actually in just by reading, you're not actually doing anything. This is one of the reasons why academia is so filled with arrogance and resentment because they filled up their minds for so many years without actually deploying that knowledge and doing anything with it, that they feel a resentment that they have not had the same level of success as other people they view as inferior and stupider than them who have just actually done things. All right. From Fritter6546. What do you think about BE shares in an HSA type account? I'm I'm still bullish on Bloom Energy. I think it's good company, at least for the medium term. In an HSA type of account, that's a a iffy one because technically in HSA you're using that in order to kind of self-insure. You're building up a health fund for yourself, and ideally you'll never have to use it for medical expenses. But the worst thing that could ever happen would be you have some big medical thing. Let's say you've lost a job, you don't have health insurance at the time, and the amount of money that you could have had in there gets cut in half because you were invested too aggressively with too little diversification in companies that were more high risk, even if they are potentially higher reward. So in HSA type of accounts, anything that it's like I may need this in an emergency, I like to be a lot more safe and diversified. Question from Nick Smarty. What's your opinion on a possible short squeeze with Rivian? 20% short float technically looks like what value area is creating higher lows over the last some time. Let's pull up the chart. So when I want to play a short squeeze, a lot of times I want to find a company that I like the fundamentals of, and Rivian, I don't. Now, that doesn't mean that you can't have a short squeeze here because like Avis, we're having, a short squeeze and maybe they don't have the best fundamentals either. But like typically when a company has a really high short interest, there's a good reason for it. It means that the company is very likely going to underperform. Now, since April of 2024, so for about 1 year now, they've been very steadily having higher and higher lows. Really solid trend line here. We also saw this this decline of the lower and lower highs kind of peter out. We've got this curved line here that is slowly now has turned upward. So there's a decent chance, we've got a bottom that has been put in and maybe shorts do start getting squeezed out. Just that alone would not necessarily be something that would cause me to open a trade on this. I'd want to see some other sort of a catalyst. Maybe there's higher than normal sales that, maybe are not being accounted for. Something else beyond just the chart and the short interest. But it could definitely be a candidate for a squeeze. From Rob's AB055, do you invest in any stocks from emerging markets? Yes. I've got a trade open on Brazil right now. Nothing in Mexico, nothing in India. I think India's got the potential for really good growth over the long term. They've got the demographics for it, certainly. It's also going to come down to their regulatory environment, how freed up the demographics are to actually perform. Also, culturally there's some cultural things as well that you have to take into account. Just because the demographics are very similar to like China 30 years ago doesn't necessarily mean they're going to follow the exact same pattern because, culturally they're very different. Similar to how like I want to make sure I'm clear here what I mean, but by culturally I'm not, this is going to get clipped and go viral for the wrong reasons. In America, for the last 20 years, we've printed less money than Japan has over that same amount of time. But the broad money expansion being way more in Japan, and I'm sorry, the base money expansion being way more in Japan has not contributed to the same amount of inflation. And the reason why is because culturally, Japanese people and companies over that same time period were largely deleveraging and they've been saving. So that offset some of the broad money pressures and base money pressures. The broad money supply did not actually expand as much as the US broad money supply as a result. And so, because Americans, broadly speaking, are going to spend more aggressively, they're going to borrow more aggressively, they're going to be levering up over that, they were over that same time period. And so, the same inputs or a couple of the same inputs might have drastically different outputs because of the way that people interact with them. All right. Question from Augmented X. Do you think we'll hit above 100 again with the DXY anytime soon? Looks like war's not ending anytime soon. Trying to time buying gold, but I'll still DCA. I don't like to time gold unless I'm doing a small trade. With the dollar, I am a little bit more bullish on the dollar. I think I don't want to put a time frame. I think pretty soon. I think we're going to pop back above into this range. So yeah, I am bullish on the dollar on DXY. From Boy Genius, what are the chances that CPI coming in hot crashes the bond market, which forces the Fed to raise interest rates and impose yield curve control? The inflation coming in hot to force the Fed to raise interest rates. It's not that the bond market crashing would force the Fed to raise interest rates. Those things would just be the result of the inflation coming in super hot. But yield curve control is the opposite of that. Yield curve control is keeping interest rates low, because without that, interest rates would spike because the bonds are selling off. Yield curve control is definitely possible. It's one of the reasons why the government was able to deleverage its debt to GDP ratio after World War II. Now, that was paired with austerity. They cut spending compared to peak during World War II, which we can't cut, or we can, but they're not going to cut spending. But those two things, like raising interest rates and imposing yield curve control, those are opposites. They're either raising or cutting. All right. From Heisenberg, thoughts on Tesla? Let's pull up the chart. So Tesla right now, in terms of valuation, it's like one of the most extremely overvalued companies in the entire market. Long term, I think that they do. The reason why they're so overvalued is because there is a chance that they're able to pull off in the time frame what investors want them to pull off, which is basically global autonomous robotaxi fleet plus global autonomous robot, humanoid robot fleet. That companies and individuals can purchase robots to do a bunch of tasks for cheaper than we can pay people to do, which allows us to outsource bad human labor to machines and frees up human labor to do things where we are more productive, or the things that we would want to do otherwise. So because of that, if they are able to pull that off, like they're going much higher. But at the current valuation, the market is pricing in a lot of that potential already. That's why it looks overvalued. So I think there are major risks in the short term, especially with the direction that they're like electric car sales have gone recently. I think some of that might be in the short term fixed. I think if they do release the new Roadster this year, I think there's a good amount of I think they'll be able to pull in a good amount of sales from a new Roadster that's like extremely cool, extremely fast. Maybe it's got some rocket boosters in it from SpaceX. I think they can, and then maybe they come out with a big SUV based on the Cybertruck platform that people maybe like more than Cybertruck, and they can reuse a lot of that investment since people don't really like the Cybertruck. It's not selling very well. So there are some things that could, in the short term, that could go to the upside as well. but I think they do have some risks to the downside in the short term. All right. Question from Bassin Bikes. Do you hold more than one passport? You strike me as the rootless cosmopolitan type. That sounds like an like it's meant to be an insult or a dig. Um, the only reason why anybody lives where they live, for the most, not anybody, most people, is because of luck and chance. That's where they were born. Um, Most people do not have the opportunity to go somewhere else that will treat them better. Um, and that is measured by subjective opinions. Um, if you want to live somewhere that has beaches, maybe you are okay with paying the extra taxes and living under the extra laws in California versus, in living in Arkansas. Um, Maybe instead you prefer to live in a place with beaches, but you don't like the high taxes, and you also don't really care about being able to order things with 2-hour delivery on Amazon. So maybe you move to some island somewhere. And so the there's absolutely nothing morally wrong with a person wanting to go where they are treated best, especially if they have been living under, like, I mean, that's literally what the American dream and just America itself is kind of founded on. It's everybody who came over from Europe came here because they're like, oh, this is a life that I prefer. I'm going to go somewhere else because that offers me better opportunities and a better life. And everybody who has immigrated to America over the last 250 years has that exact same mentality. I want to go there because it's better for me. And to the extent that in the future that changes and other places offer better opportunities and other places have have better metrics of people saying, hey, my life is better because of all things considered by going somewhere else, then those places will outcompete and they'll attract the best people and they'll attract the most talent and the most wealth, like America has for so long. There's nothing inherently wrong with people doing that, especially because the only reason most people who ever do have a choice decide to stay where they were born usually is out of like a religious patriotism. And by religious, I mean like patriotism feels like a religion, like it feels like a duty. But it's like you were just born there. If you just happen to be born somewhere else, then you'd be patriotic about that other place. So there's nothing inherently immoral about wanting to go to the place that has the best opportunity. I mean, that's literally why America exists, because people have been doing that for a long time. Okay. From Mr. Chadley, it has become apparent through the last correction that I am over leveraged on asymmetric speculative type positions compared to my overall portfolio. How would you get your portfolio more in balance? I mean, you just start, well, two ways. If your portfolio is fairly small overall, you can do it through contributions, which means um, compared to your income. So let's say you've got like a 1-to-1 ratio between your portfolio value and your income. You've got 100 grand to your, of your total investable assets, and you make 100 grand a year. In that case, it's like, just do it through new contributions. Take all of the new money that you are saving to invest and plow that into the rest of your portfolio to get that more in balance. You'll be able to get there pretty quick if you do it that way. If your overall portfolio is 5x or more than your current income, so you've got a $500,000 or $1 million portfolio value, and you make 100 grand a year, it's going to be a lot harder to do that just from your own income. You're going to have to rebalance. So you're going to have to sell some things and rebuy some other things. So it depends on your portfolio value compared to your income. All right. From Bitcoin Hopper. Thanks for the story and your thoughts on retirement. Awesome way to look at things and to go about them. Appreciate you. Well, I appreciate you. Let's see here. From the Buckman, if the Strait of Hormuz remains closed or does not fully open by the end of April, do you think a crash or hyperinflation is likely? If so, where do you put your money? Crashes rarely happen soon after corrections. So the fact that we had in the course of 5 years, three bear markets, which was 2020, 2022, and 2025, those were technical bear markets because they went down at each one of those at least 20%, um, is historically unprecedented. Usually, bear markets occur much less frequently than that, like two a decade, not like five per 5 years. Um, and then this year, we also just got that 10% correction. Meanwhile, earnings are growing. Um, Forward earnings are growing. Um, Valuations on a lot of the biggest companies are improving during that time. So the fundamentals of the companies that make up the market over the last year or so look extremely attractive. So it would surprise me if um, May, end of April, beginning of May, June, really anytime this year, we do actually see any sort of a market crash. It's just very, very statistically unlikely for something like that to happen, especially after a bear market a year ago and another 10% correction just now. Um, Hyperinflation also fairly unlikely because as it stays closed, dollar flows dry up. That increases liquidity strain on the system, which increases um, the risk of acute spikes in the dollar value as dollar shortages, like pockets of dollar shortages, appear across the system. So neither one of those things, in my opinion, are very likely. They're possible, yes. Likely, in my opinion, no. Question from Mark Jones. What about just living on dividends? Definitely possible. Keep in mind, when a company pays dividend, that is money that the company is saying, we are not going to use this for growth. We're just paying this out to investors. So the value of the company, like when the dividend is paid out, it adjusts for the exact amount of the dividend. Um, So it's not like free money. Like if $100 per share company pays a dollar dividend, it is now worth $99. Now that doesn't mean that like other buying and selling can't happen and the price won't fluctuate beyond that or to compensate for that, but it means that it lost a dollar per share. Um, and so sometimes companies that pay really good dividends, there's a risk there that they're losing too much cash, they're bleeding too much cash, and they're going to have to lower that dividend. And then their stock is going to tank because people are only investing in it because of the dividend and they haven't been reinvesting enough for growth. In general, though, at least a moderate dividend is a sign of fiscal responsibility, and companies that consistently pay okay dividends for a very long time tend to outperform most players in the market. Okay, from unknown YTX. At what price would AI plans become too expensive for you? My prediction is that these tools will experience steep price hikes. It is possible. However, as chips get better and as models get more efficient, there's a possibility that they're able to escape kind of like liftoff. Like right now, like there's the gravity when you're a rocket going up, you need to escape that gravity. So you need enough fuel to get past that. If you don't, then you're going to come crash back down. See like a similar rubber band effect right now where it's like these companies, the reason why they're going public is because they can't get enough cash from private markets in order to keep on going. Their runway is running out. Because all of their services are so heavily subsidized, they're losing money on them. They lose like, for every dollar they bring in, it costs them $3 or maybe even more. Um, that's why they limit you on how much you can use their products because they're losing money on you. They won't let you sign up for more expensive, higher plans because like they want more people to start using these products. They don't want one person to be, soaking up all of their losses. Um, and so the idea is, okay, we need to just be able to last long enough and survive long enough to become profitable in the future. This is similar to like Uber. Uber was unprofitable for forever, and really their game plan was uh, for a long time. It's been driverless cars. At some point, we'll be able to not pay our largest expense, which is drivers, because we'll have fleets of cars that drive themselves, and then our profit margin will be there. But you have to be able to last that long. So is it a gamble? Absolutely. Is it a definite guaranteed bubble crash and burn? Absolutely not. Far from it. At what price would it be too expensive? It just depends on how much it costs to produce the thing that it is producing. Is it cheaper for me to hire a person, or is it cheaper for me to have the program do it for me? That's it. From a business perspective, it's like it's always in free market exchanges. What is the least I can give up for the most that I can get? Um, and so if that's going to last, then the models need to get more efficient, chips need to get more powerful, and at some point prices may go up for sure, but right now they can't go up enough to make them profitable, otherwise people wouldn't be using them. Okay, question from Ginger 2. Thoughts on the Boglehead strategy, basically VT and chill. There's nothing wrong with it. It is so easy to match market returns, to achieve market returns with investing. The only thing you have to do is just invest in the market. And so for probably 90% of people, the best advice that they could follow is spend less than you earn, invest the difference in VT. Or really, there's nothing special about VT, maybe VOO, maybe even SPY, even just an automated account of some index funds. Like it's spend less than you earn, invest the difference in the market. For 90% of people, that's going to allow them to escape poverty, because most people, like over 50% of people making 300 grand a year, live paycheck to paycheck. So most people, that is the problem. It is they need to spend less than they earn, and they need to invest the difference. And index funds are great. For the people who have already built the discipline and the habits and are starting to invest and have, at least somewhat of a portfolio, then it makes sense to start to try and do things to increase your returns. If you have like less than 10K to your name, doesn't matter. Like, don't worry about trying to go from 10% to 20% a year. It's not going to make a difference for you. You need to build up a portfolio first. But once you have a decent chunk, then increasing your returns, even like 1%, it matters. 1% on 10 grand, nothing. It's $100. 1% on $1 million. Now you're talking. Now you're looking at 10 grand. So it definitely matters more and more the larger your portfolio, and matters less and less the smaller your portfolio is. All right. Shadow Ranger says Warsh is a distraction. Judy Shelton will be the Fed chair. That would be such a crazy curveball. Man, I wonder what the odds are for that on betting markets. Betting markets odds, Judy Shelton next chair. I don't even know if that's okay. She's at 0% right now. So does that mean if you bet on Judy Shelton, there's like a huge... Oh, well, no, because I'm looking at nomination. I wonder if there's a way to bet on that. I wonder if there's a way to bet on who will actually be the next Fed chair and what the payout is. That'd be crazy. I don't think that'll happen. Let's see here. Boy genius. My understanding is that yield curve control is when the Fed raises interest rates but buys treasuries to keep prices from crashing. Um, Yield curve control is exactly what the words sound like, yield curve control. So when they do something like QE or like right now, they're not outright controlling the curve, the yields across the curve. When they raise and lower interest rates, they're just changing the Fed funds rate. There's T-bills, there's notes, there's bonds across the curve. That's maturity. And so that's, all the way from 4 weeks to 30 years. The Federal Reserve is not outright controlling what those interest rates, what those yields are. They're influencing them slightly with their QE or their QT by their buying and selling, but that just adds some buying and selling pressure to those bonds. There's other free market forces at play. Yield curve control is them specifically setting a target rate like they do for the Fed funds rate across the yield curve. So they're saying the 10-year will be 2.5 to 3%. The 20-year will be 2.5 to 3%, whatever. And that means that anybody who buys or sells enough of those bonds that would push the yields past their range, they have to soak up the difference. Yield curve control is typically done to suppress interest rates because it's done so that the government can borrow at lower interest rates than they would be able to with just the free market. Um, and so the Federal Reserve comes in and says, we will buy any and all bonds necessary in order to make sure yields do not go above 2.5% or 3% or wherever they have it pegged. That's what yield curve control is. They don't have the ability the Fed doesn't have the ability to engage in yield curve control the opposite way, like if they wanted to push interest rates on the long end of the curve higher, past just draining their balance sheet. Because once they don't have any other bonds to sell. So then you'd need the government to step in and just start borrowing a ton more and issuing a ton more. But there's really not a scenario with a high debt to GDP ratio where something like that could happen, because where's that money coming from? Like it's just like not the way things work at the stage that we're at right now. So yield curve control would be to suppress yields across the curve. Question from Alex Kimmerly. Thoughts on consumer sentiment being at all-time lows? That is the crash catalyst. Consumer sentiment being at all-time lows, in my opinion, is a contrarian indicator. It's like the time to buy something is when everybody thinks it's the wrong time to buy something. The time to sell something is when everybody thinks it's the right time to buy that thing. Um, because the crowd, especially retail, tends to be late on that curve. By the time everybody feels really bad about the economy, it's because they've been feeling the pain from things being really bad for a long time. Um, and so as a contrarian indicator, that would mean things are kind of, the energy is kind of, you know, wound up and ready to spring. All right, GPIQ. There's a question from the Walick. So let's pull up the chart. GPIQ. Oh yeah. All right. I'm never, ever, ever, you're never going to see me say that these things are good. I'm always going to warn people to stay away from these things. So this is the Goldman Sachs NASDAQ 100 Premium Income ETF. There are tons of different funds like this. What they do is they invest in an underlying, like in this case, they're invested in the NASDAQ 100 index, and then they're using options in order to produce income, extra income. So their dividend yield is 9.9%. So you're looking like, hey, if I just plow, let's say I put $1,000,000 in this thing, I can earn 100 grand, basically risk free, and just in dividends and just ride on that forever. The question is, where is that money coming from? Like, what's the trade-off? What are you giving up? So I haven't looked at GPIQ. It's a very new fund. It started in 2023. So this might not work on this one because it's so new, but let's just check. Okay. So this one, the underlying is the NASDAQ 100. Okay, so let's adjust this for its dividends. Okay, adjusted. So now we're looking at the total performance, which includes the dividends, and we're gonna overlay QQQ. Oh, and would you look at that? It did work, even though it is new. So QQQ since inception of this fund, QQQ has returned 90%. GPIQ total return, including the dividends, has returned 78%. So you're giving up total wealth in return for what you think is a dividend. The reason why these funds underperform is because they don't use discretion on timing for the options. So they're selling calls many times at strike prices below their cost from when they just had to recently get back in. The stock goes up, they lose the shares at a loss, have to rebuy back in, and just continue to roll over the same strategy regardless of market conditions. So they're selling calls during time periods where the pricing is not good. This one, maybe they're also doing cash secured equity puts. Maybe they're doing some credit spreads with puts and calls. I'm not sure their exact strategy, but what I know is I've never looked at one of these premium income funds, compared it to the underlying, and seen it outperform over the long term. It does not happen. They're always worse, which means you're just giving up money because you're like, oh, 10% in my account for free looks good. It's like, or just buy the underlying. Maybe every once in a while when the pricing is good, sell some calls yourself. And when you need the cash, sell some shares. You're underperforming the underlying. They don't make sense because they cannot exercise discretion. I've never seen one that outperforms. All right. A question from American POV Show. What is your ROI percentage just on only stocks? My overall portfolio, what I quoted earlier, my compounding annual growth rate over the last 5 years, 39%. That's my overall portfolio. I don't know what it is on just the trading account. I don't know what it just is on my stock portion of my portfolio. I don't think that really. I mean, I could break it down. I could go see. I don't have that information in front of me. I know altogether that's what it is. All right. Question from Man of Reason. How do you account for volatility when you are setting up to cover big losses? Not really sure exactly what you mean by that question. I try and avoid big losses. I mean, that's the number one thing. Like early on when I started trading, I was trading incorrectly, and I blew up my account. I lost 95% of my net worth on one trade. A couple of years later, I thought I had figured things out. Thought I was trading differently, but I was still exposed to massive hidden risk because I didn't understand. I lost like 65% of my net worth. So I've blown myself up a couple of times, and because of that, started on a deep learning journey of like, what am I doing wrong? Realized I was kind of playing the opposite. I was trying to play the house when I couldn't set the odds. The reason why the house wins for like the lottery and for gambling is because they can set the odds. In the markets, you can't. And so you feel like you're playing a probability game of I can't lose because it's so statistically improbable that it would only happen once every 1,000 lifetimes. And then it happens. And every one of the best investors and traders throughout history has a story like that, where early on they blew themselves up because they were trading in a way that exposed them to large losses. And they learned, okay, the number one rule is no matter what, don't have the potential for a large loss. The easiest way to do that is always take small losses, because you can't have a large loss unless it starts off as a small loss that you didn't realize. But if you always realize every small loss, they can never turn into a big loss. My preferred way to do that is through position sizing, because then in a worst case scenario, you lose 100% of that position. It's a very small percent of your overall portfolio. You can also do things like hedging. If you're trading with stocks, you could do stops. Um, there's all sorts of ways to mitigate your risk on individual positions. But I don't know if that exactly answers your question. Hopefully it does. Um, Hopefully that answers it. Okay, from Danston, loving your channel. What do you think about the rally in space stocks recently? Will they top out before or after the SpaceX IPO? Probably after, because of the way that these IPOs are going to happen is going to funnel a lot of money, probably more than should be, into the into the into SpaceX, into the IPOs particularly. But the probably the boom from that and the hype will attract a lot of money from retail into the space. So we'll probably see like a big pump and then dump. That's my expectation. It could turn out very differently, but that's kind of what I expect to see happen. All right, question from Boy Genius. Do you see cash? Do you see cash is trade? Cash? Do you see cash as trash trade happening as soon as Iran finally opens the strait? Um, I don't know if cash is trash as a trade. Cash is trash because over the long term, it loses you purchasing power because of inflation. So it's always balancing act between I need to have the smallest possible allocation to cash, as to not lose to inflation, and the largest possible allocation to cash so that I'm never a forced seller and I can buy assets when they're at discounts. So it's always balancing act between those two. For my cash position, I like to keep it in things like T-bills, money market funds, high yield savings accounts, because then at least I'm getting close to breaking even on inflation. Um, but just because other assets are like skyrocketing, that doesn't mean that you should necessarily use that as justification to decrease your cash position, because in fact that may be like a time where you're like now over allocated to your risk assets and you need to increase your cash position. Okay, let's see here. Question from Andrew Jackson. Other than TLT, what should I buy to capitalize on the banking rule changes? I think it's going to be broadly bullish for asset prices in general. So um, there are very few focused plays on this. Like even just doing something like buying the banks, it's like this is so this is signaled so far. It's not a surprise. This is priced in over such a long period of time that that once the supplementary leverage ratio gets removed, it's like the markets will have expected that a mile away. There's not going to be an acute move from that action from that event actually happening. Um, the anticipation of banks making more profits as a result of this may not be accurately priced in, but it may be. So, in my opinion, there are not many ways to play the deregulation itself, like with individual plays. But it will be broadly bullish overall because it's stimulative to the economy in a way that is more aligned with producing real profits rather than just inflating asset prices. Um, let's see here. From Alex Kimberly, covered call funds underperform on an up market, but overperform on a flat or down market. Not necessarily. I mean, like I said, like go through and pull them all up. Sometimes they're on individual stocks, like MSTY is the one for MicroStrategy. Um, there's I think TSLY, that's one for Tesla. There's JEPI. There's there's a bunch of these funds, and they attract a bunch of investor money because that dividend just looks like crazy. Like, oh my gosh, it's invested in the S&P 500, and also I get a 10% dividend. It's like, but it underperforms, even including the dividends over the long term. You're just missing out on wealth you could have had otherwise, both in up and down markets. All right. Thoughts on high yield bond funds. This is from Boya 6585. High yield bond funds, probably right now could be a good bet. I don't have a trade on high yield bond funds right now, but if we take a look, HYG, this could be a really interesting one right now. So number one, looks like let's go even longer here. Let's go to a weekly chart. So we've got some really good performance since October 2022, just a nice grind higher. The downside here is like, hey, if we don't see any financial easing from the Fed, deregulation, anything like that, there is some definitely some downside risk here. The upside is lower rates will allow a lot of refinancing. Economic growth, obviously, I mean, it's a bond play, so low rates equals high prices. But the question is whether the forced low rates like on government bonds translates over to corporate bonds, especially, junk. In my opinion, this could be a decent asymmetric play to the upside, maybe to the downside also. I don't think there's anything like inherently dangerous or wrong about that trade unless you just have a position that's way too large. Question from Wavy McFly. Which sector are you the most bullish on going forward for the next 5 years? All right, I'm going to answer this question if you were like, because if you were forcing me to pick one sector and I couldn't change it for the next 5 years and I had to like put my whole portfolio into it. I mean, if it was one stock, it'd be Amazon. And so one sector would just be, large tech. But that doesn't mean that I'm like saying that I'm actually committed to that for the next 5 years, because if the situation changes in 2 months, my opinions will change. And that's kind of the nice thing about being an investor is like, you don't actually have to, commit to something. Like you trade and invest based on what is happening, not on what you think should be happening or what you wish would happen. Like don't impose like rules on yourself like that. The goal of investing is total return. So my guess is that will probably perform the best, just because a lot of companies like Amazon are positioned to profit the most from the technological revolution that's happening right now. Like within 5 years, Amazon's robot fleet it'll definitely be larger than their human fleet. Probably, could be even like double. They have a huge moat that nobody can come in and compete with them on their logistics and their infrastructure and everything that they built over the last couple of decades. And now their profit margins can explode on that. They take this company, Amazon. Their strategy has always been, we're going to enter an area and we're going to basically lose money or break even on that until we become the main player, so that nobody wants to compete with us during that time. Like with Kindle, like e-reader books, they went into that space and they were like, hey, we're not going to make money on this. We're going to sell these books so cheap that nobody else is going to come in and want to participate in the space because there's no profit margin. If they're going to come in and compete with us, they're going to have to charge more than us. And then nobody's going to buy from them. And nobody's going to want to do what we're doing here, which is basically almost losing money. And then once they have an ecosystem built and everybody loves them and loves what they're doing and continues to buy from them, now they have the ability to increase profit margins. Brilliant business model. And they're doing that now with like, with everything that they built with shipping and their logistics and their transportation and their 2-hour delivery on anything you could ever want in the world. Um, Not to mention all the other stuff that technology and automation is going to be making more profitable for them. So, but again, if the situation changes, like, then my opinions will change. So I'm not actually locked into that for the next 5 years. All right, question: what is your workout regimen and diet? I'm on a health journey. I lift weights every single day of the week. I would say every day because like 5 days a week. I don't lift on the weekends mostly for the most part. I've built a nice gym in my garage, so sometimes I go out there just for fun. Um, Specifically for the purposes of hypertrophy, because that's fun for me. Exercise in general is of pretty much any kind is very healthy. So you want to pick the one that is most sustainable for you that you're going to keep on doing. And I will keep on doing that because I enjoy doing it. Um, and I've been doing that for 5 years now. I eat basically kind of like a hunter gatherer paleo type of diet, mostly whole foods, 200 grams of protein from, natural sources, fruits and vegetables, potatoes, rice, as little processed food. Like if it has nutrition facts on it, like if it has an ingredient label, like processed, I try and eat as little of that as possible. Um, and you have to track your calories. I know like a lot of people who say like, keto or carnivore or paleo or whatever, they're like, oh, you don't have to track your calories. It's like, no, you still do. I guarantee you, if you don't, you're eating more than you think you are. You're probably eating twice as much fat as you think you are. And fat is 9 grams of, or 9 calories per gram. Um, Way more than you need for any optimal hormone health. Anyway, lots of different little anecdotes that I could share, but basically 5 days a week, lifting weights, 3, 4 exercises per day, um, 5 to 10 reps, is, I go close to failure on every single set, at around 5 to 10 reps, and make sure I get enough protein in, and make sure I'm tracking everything I'm eating so I'm not over consuming. All right, from TapRack, for a two bucket strategy, what is the most tax efficient muni position for those in a top tax bracket? I don't know because I don't invest in bonds, so I don't have an answer for you there. Um, there may come a day where I'm like, hey, I want the tax efficiency there, but what you're giving up there is the return for the tax efficiency. Usually, it comes out it's pretty similar because the arbitrage there. It's like it's been, but I don't invest in bonds, so I'm unfortunately don't have an answer for you there. Um, why is big money? This is from Boy Genius. Why is big money like Warren Buffett sitting on so much bonds? It's about a third. So the portfolio that I've always said that I like the best, that I use, that I've recommended is 30% reserves, 30% stocks, 30% real estate, 10% speculation. And in the reserves, for me, I break that down to 5% cash, 5% Bitcoin, 20% gold. But Berkshire Hathaway being in 30% T-bills, that's 30% of their portfolios in reserves. It's like it's very similar to like a modern portfolio theory or 60/40 stock bond kind of split. It's nothing crazy. Now, and I bring that up because it's like if you are watching Berkshire Hathaway and saying I want to follow along, most people doing that are like all in cash. It's like you're being way more conservative than Berkshire Hathaway is if you're 50%, 60%, 70% in cash. He's 30%. He's like a third. So there's nothing crazy about that. I typically keep about 30% in reserves. It's just not all in T-bills. Um, all right, I'm going to do one more question here. Um, Currently down 40% on SOXS. Want to cut my loss this week, but it really makes no sense to me. Semi hasn't topped. Thoughts? Let's take a look at SOXS. Oh man. So, guys, whenever you're going to be buying or selling, or looking at an ETF, always zoom out. So, this is what SOXS looks like since inception. So, on a split adjusted basis, in 2010, they were trading at 3,952,949,789 per share. And over the course of the life of this fund, let's zoom in and kind of just scroll. They have just bled. They go down. They go down. Look, reverse split because they were so low per share that they had to do a reverse split. And then they go down. They go down. Oh, they have to do another reverse split. They go down. They go down. Oh, they have to do another reverse split. They go down. They go down. Oh, they had to do another reverse split. They go down. They go down. Oh, they had to do another reverse split. They go down, they go down. They had to do another reverse split. They go down, they go down, they go down. Oh, they just did another reverse split. Um, so the question is, how far can it go down? The answer is it could go down another 100% from here. It funds like this will always um, uh, they will always get closer and closer to zero. They will never quite approach it. The fund's not going to shut down, but they will always continually get closer and closer and closer. Um, And the reason why is because of something called beta slippage. These are leveraged funds, which means on a daily basis, they will do whatever their leverage is, in this case, 3 times whatever the underlying does, in this case, the inverse. So even on, you get these periods of time when the stock market crashes and this fund will pop. You're like, oh, I could have made a bunch of money on that. It went from $338 per share up to $1,000. I could have tripled my money. But it's like, yeah, only if you would have timed it perfectly. Because if you bought in 2024 and you sat on this thing for 1 year before that pop, you didn't even break even. These funds always bleed money. They are only appropriate for day trades. The reason why they bleed money, I said it just a moment ago, is because of something called beta slippage. This is a leveraged fund, and losses are more powerful than gains in terms of movement. So imagine over the course of a few months, the underlying goes up. Let's say the underlying goes up 10%. That means that this fund will go down 30% because it's inverse. Well, let's say that the underlying then goes down 9%. Well, the underlying is back down to break even because a 9% loss is equal to a 10% gain, roughly. You go start at 100, you go up to 110, 9% of 110 gets you back down to 100. And it doesn't matter the order. If you go from 100 down 10%, you're at 90. You have to go up 11% then to get back up to break even. But the leverage fund is doing that on a leverage basis. And so it's not going down 10%, it's going down 30%. Well, what do you need to break even after a 30% loss? You need a 42%, almost a 43% gain just to get back up to break even. So when the underlying goes back up 10%, your leverage fund is only going back up 30%. That's not enough to get it back up to where it was before. So over time, then, because of the volatility in the underlying, this is just going to bleed because losses are more powerful than gains, and the leverage losses need exponentially higher gains just to get back up. A really extreme example of this is, let's say the underlying goes down 40%. The underlying then needs to go back up. What is 60% to get back up to break even? I think maybe it's more. I think it's 60%. But if the underlying goes down 40%, then the leverage fund is actually going down. If it's a double leverage fund, it's going down 80%, which means it needs a 500% gain just to get back up to break even. And that underlying is not going to do that. With the same, if the underlying does go up enough to bring up the leverage fund 500%, the underlying is going to outperform because the leverage one is just getting back up to break even. So, and this is not true only of inverse funds. This is true of long funds as well. So when you look at SPXL, you're like, oh, I'm in a leveraged fund. So from the last, let's say the last 5 years, SPXL, it's a triple leverage bullish fund. But if we compare that to the underlying, all right, well, it's outperforming right now. Let's see the last 1 year. I'm trying to show you beta slippage happening on a leveraged bullish fund. Well, I guess looking at the last 6 months here, it's basically flat, even though it's leveraged. And the reason why is because the loss there was more powerful than the gain. Now, if you're leveraged on even if we go like right here, we're almost even, and your losses during those times are a lot bigger. Zooming out, you'll see more and more outperformance because zooming out, you have more and more straight up moves. But even if you look at like if you had some bad timing and you got in right here, you're still only looking at, the leverage fund is 68% up right now and SPY is up 50% right now. Meanwhile, you had way, way bigger drawdowns during those time periods. So during the down times, it's like it crushes you. So if you can hold these things, the bullish ones for the long term, and you're in something that will continue to go up, then you can outperform. But during the bear markets, they'll crush you. So you can't get, you can't be leveraged yourself and get squeezed out. But especially the bear funds, those ones will just bleed over time. And a lot of people will look at doing things like the leveraged funds on like MSTR. I think MSTX is the double leveraged MicroStrategy fund. It is drastically underperformed the underlying, which in this case is MSTR. So MSTX since inception is down 84%. MSTR since over that same time frame is up 24%. So the hard part with these leveraged funds, even if they're bullish, is they only work over the long term if you're in something that is going to continue to go up for the long term. And a lot of people got sucked into bullish leverage funds on things like MSTR or like there's a Tesla one probably or whatever. And especially the bearish ones. It's like, even if you're right on the bearish ones, especially, you have to be right about the time as well, because even if semis crash from here, and this thing spikes up, 1,000%, it's going to go from $18 to $180. And if you bought it 1 year ago, it's still not enough to break even. So that's why they're designed for basically day trading only. So, all right, that's all, guys. I've been going for over 2 hours now on this. So for anybody who joined late, you can just watch the replay after if you want. You can go through, scan through the questions in the chat to see which questions I answered, if there's anything you want to see. But I'll do these live streams as often as I can when I have the time to do them. Lots of good questions today. Appreciate you guys. Thank you for watching. Thank you for interacting and asking. I'll keep on doing them as long as you guys keep on participating. So we'll see you next time.